What is up, guys? I'm back here again with another one. In this video, I'll be sharing a nice entry technique for sniper, basically zero drawdown entries. Sit back, relax, and enjoy. Please note, any information herein is not intended, nor does it constitute financial, tax, legal, investment, or any other advice. So the major issue here is that waiting for the market to get into your key point of interest should also be accompanied by monitoring how the market is coming into your key point of interest. So a good example is, let's just say one wants to buy when the market arrives into this zone. And for example's sake, this is an H4 zone or H1, whatever the case may be. Of course, when the market arrives in here, I want to place a buy position. But the question is always, when do I actually go for it? What should I see? What is it that drives me to say, let me press buy? And I would say using this entry technique, monitoring how the market is coming into your zone is very important. Okay. So because this will be a buy setup, it is highly likely that the market will be approaching your zone probably in this manner. Okay. And so it's this manner that one needs to really take note of. Okay. And so obviously you can see the market is pushing to the downside. And of course, on a live market, it won't be this pretty, forming lower highs and lower lows. But one needs to understand what we call floors. Okay. The market will print these floors as it edges closer to the zone. And what constitutes as a floor is actually very important. So a floor is an area where the market got to, right? So we came here and we got to here and we failed to continue and then we pushed up. All right. So that makes that a floor because we ended up even breaking below. That's a floor. Okay. The same happened over here. On our way down, we got here, we failed to break, and we pushed up. All right. Same thing over here. We got here, failed to break, and then we pushed up. So the market is creating floors, and then it ends up breaking them as we push to the downside. Okay. So how you get those floors is exactly this way. And one wants to mark them, especially to use them as reference for when we enter our key point of interest, which is this gray zone here. And so, of course, there's this last floor here before we entered our zone. And it's very important to keep your eyes on that. Okay, so now, one shouldn't have pressed buy yet because the market is simply not ready. Okay, what one actually needs to consider is how the market reacts when we have interacted with the so-called demand that we're expecting to come in from here. Okay. All right. And so, of course, we're expecting a buy movement, and that would be really good. But I would say it is not enough for a person to buy yet, especially if you want something that is very much zero drawdown. Okay. And so what I do with this model is I wait for the market to break, okay, the past floor, right? Break and close above that past floor. Okay. And then come back to retest the order block that is responsible, right, for the break and close of that past floor. And I know someone could be wondering, but what time frame would this be on? It's very subjective in terms of the market conditions in front of you. This could be on the M5, for instance, where you have drawn up these floors. You can even head over to the M1 once you're more experienced and you've back tested enough to develop confidence with this. Okay. So what are we saying here? We have floors coming into the zone, all right? And what has happened is we have broken above, okay, a past floor. And because of that break and close above a past floor, to a certain extent, one can actually start noticing that the market wants to push up, right? And as opposed to placing your buys here, you want to get an order block, right? That is responsible for the break and close, and then you place your entries, okay? So now, when it comes to TP levels, depending on if you're a scalper, right? I would use the very same past floors as TP levels if I'm scalping, okay? If I want to get quickly in and out, I'm in over here, and because there's a past floor over here, I'm out, okay? And if I want to hold more, I still maintain reference of these past floors. Okay, my drawings might not be straight. Here's another past floor from above, and I maintain reference to it as to say that, guess what? This is also a TP level. This is only if I'm scalping that I would want to get out at. The reason is that at these past floors, these next past floors, the market usually retraces and then pushes up and all of that. And so now if you're in heavy-handedly, right, those retracements could basically eat you up. So just for a back testing sake, I'm going to also show you a live example of a trade that I took earlier using this exact same entry model. Okay, so for back testing sake, let's just look at a zone that could have served as a key point of interest. Right now, we're on the H4 time frame. The market has been pushing up in this region over here, and one can actually say that this is a high and this is a higher high. And of course, because of that, one could have this whole area as a low. Okay, to say that this is a low. If the market comes in here, I want to look for buys because it's a low. All right. So this also helps you so that you don't enter prematurely, because for as long as those past floors haven't started breaking, you have no reason to just jump in. Okay. So this is my key point of interest, and this is the movement of the market approaching, the movement that one needs to assess of the market coming into my key point of interest where I want to buy. So this is on the H4 time frame. So one would then need to scale down. I think for this one, I'll do like an aggressive scale down, and I want to head over to the M30 and all those nice time frames and look at these past floors. So this is the push to the downside, and I can see a floor over here on the M30. Okay. Why is it a floor? As we were pushing to the downside, we got here and we failed to break, and then we ended up pushing there and then we broke. That makes it a floor. Okay, right. Now, there's also another one, but it's within my key point of interest, and I'll just mark it for the sake of, understanding market movement. So what happened over here? The market came into my zone, and I haven't placed any entries yet because the conditions that I look for have not yet materialized. Okay. I would also put this past floor all the way here. Okay. Why? I mean, because as the market was pushing down, we got here and, for a strong 30 minutes, we failed to break. Okay. But remember, my entries are all the way here in my key point of interest, preferably. So let's follow what the market actually did. The market came into the zone. All right. We got in, and this is the only time we broke above and closed above my past floor, which is here. All right. So let's look at it. We pushed up. All right. And now finally we're breaking and closing above what I'm calling a past floor. So for me, I then look for the order block responsible for the break and close above that past floor, and that is an entry. My TP level is also that past floor if I'm scalping. So my entry goes here, my stops are probably somewhere around here, and you can only imagine by the time we get here, I could already be out. And in terms of risk to reward, that makes sense. In the event that I want to hold the trade for longer, still, this past floor becomes my TP level. And for obvious reasons, right? Can you see as we push to the upside and when we interact with that past floor, what happens is that there's a retracement. And this is on the M30 time frame. So you can only imagine what this does to your psychology. If, for instance, for 2.5 hours, it looks like we're eating away at your profits. That's why these are TP levels. Okay. So now let's move over to a live example of the trade that I actually took and how I used this very same method. And so a great example is a trade that I actually took today. If we're to view my Instagram stories, all right, I had shared this trade setup earlier. And so what we have, it's volatility 100 on the H2 time frame. I saw this strong demand from the past that took out that structure. And so I was expecting for the market to come back in here between the zone 1190.75 and 1179.28. And of course, I was aiming to get a bounce, all right? By bounce, obviously, what I mean is that my TP level would be at the end of the arrow. And in terms of risk to reward, this actually makes sense. I'm only willing to risk this much and I will be getting out there. But that's not what happened. In fact, I held the trade for longer because the market showed a really favorable reaction at the zone. And so this is actually the entry that I made. As you can see, it was 1190.73 where the market dipped into, and then it pushed over for a long period of time. Okay. So now, obviously, one would need to look at how the market actually reacted in terms of the exact same thing, but this is the trade, right? These are my coordinates, and the market came in here and the trade was taken. So let's discuss using this entry model how one can spot that. So, I was really on the extreme end of things in terms of the lower time frames, and on the M5 time frame, right? What I saw was this is the movement of the market coming in. And so obviously one would just need to mark what I call the past ceilings, okay? So there's one over here, past floors, sorry. There's one over here, okay? And there's also another one all the way there, but I'm not interested in that. I'm interested in these ones that are near my zone because I'm trying to make an entry in here. And so obviously the model is such that once you've marked these past floors, and if you see the market starting to break above them after having visited your zone, you want the order block responsible for the break. So it's a break and close preferably. And if we can come back into the order block that's responsible for the break, that would be an entry. Okay. So these other past floors that are ahead can be kept in as actually TP levels if you want to scalp the trade. So for instance, now if you go to the M1 time frame, this is what I saw and what made me enter. So we have a past floor here. What happened was the market came in and we got into my zone. I had not entered yet. And then finally we broke above the past floor, right? We closed above and we retested, right? An order block that is responsible, right, for the break of that past floor. And this is where I place the entry. Okay. So now remember what I said, that your next floors can become TP levels. It's as simple as that. Once the market reaches here, you can actually get out. In terms of risk to reward, you would have done more than enough. And of course, you can choose to hold. But the issue here is at these next past floors, the market usually does that. So it's something that one needs to prepare for. Right? There's a possibility that at the next past floor, the market will retrace. This is why this entry model is so excellent in terms of managing your risk to reward. So if you really place your entries here and you monitor everything going on, right? If, for instance, you see that the market is disrespecting that order block and is somewhere around here, you can quickly get out, right? Before the zone is disrespected altogether. However, when the market starts pushing favorably, you can wait patiently and aim to get out at the past floor. So that is just an example of this model here. All right, so there you have it. As always, it's important to stick to your strategy and wait for the conditions to align to use it. If you like what you see, feel free to contact me for the list of my services. You can find my contact details in the description of this video. Until next time, cheers.